Often, we refer to this period as the Tronics boom, as it was marked by electronic and silicon names. During these years, a simple name change by even a shoelace company to something like Powertron Ultrasonics could double its share price in respect to its actual earnings within a matter of days. During this era, the Securities and Exchange Commission uncovered extensive market manipulation and fraud. The underwriting investment banks withheld shares to keep the market thin, thus generating rapid price increases in the aftermarket. This situation evolved into financial debauchery.
To avoid ensnarement by the SEC, issuers distributed adequate prospectus with warning labels resembling the ones present on cigarette packs. In response, the SEC took the position that, though it could warn fools, the Commission could not prevent neophyte investors from handing over their money. By 1962, the boom had gone bust. As the merry-go-round broke down, the SEC suspended brokerage firms that had soured the 60s.
The third great merger trend struck from the 1950s to the early 1970s. Many companies sought to combine horizontally with firms that were involved in the same business or vertically with suppliers or customers. However, a new wave of conglomerate mergers occurred as firms combined with companies in completely unrelated industries that enjoyed sales curves that ran counter-cyclical to one another.
In compliance with antitrust laws, most large firms are restricted from acquiring or merging with other companies within the same industry.
Firms seeking an acquisition could do so more easily across industries. However, executives discovered that the acquisition process could produce growth in the earnings per share of a company. They discovered too late that a bubble driven by conglomerate mergers would develop during the late 1960s. When the acquisitions stopped, someone got burned.
The conglomerate bubble proceeded like a chain letter. Such tactics worked for a while because investors in the 1960s tended to be more interested in steady, rapidly rising earnings and less concerned with how the sausage was made during a bubble that reeked of the public relations messages of promoters. However, the beginning of the end for the conglomerate bubble occurred when electronics producer, defense contractor Litton Industries announced lower than expected quarterly earnings in January 1968.
Next, the Federal Trade Commission launched an investigation of conglomerate mergers in July of that year. Market prices fell again. During this aftermath, the SEC and the Financial Accounting Standards Board called for clarification of reporting methods and standards for conglomerates.
This call triggered another large sell-off that resembled the collapse of the South Seas Company. In summary, let us review the characteristics of the conglomerate bubble. First, there were management difficulties in attempts to juggle diverse product lines. Secondly, the new financial math of conglomeration was far from transparent and led to expressions of viable concerns by regulators and other parties. Third, acquiring companies needed to have larger earning multiples than those firms in the shrinking supply of target companies. Fourth, conglomeration eventually resulted in lower earnings and flat price-to-earnings ratios. Fifth, in turn, lower earnings led to the shedding of unrelated, poor-performing acquisitions. Throughout the next few decades, a series of relatively minor bubbles occurred. However, the core of the conglomerate and other bubbles continued to follow a slow build, followed by a rapid ascent to an unsustainable peak before a sudden collapse. In the late 1960s and beyond, we have experienced crises fueled by concept stocks, ones whose current valuation appears out of line with traditional valuation metrics. Mutual funds proliferated. Furthermore, the fund holdings tended to be stocks that possessed an exciting concept and generated great near-term performance. As many of these funds soured in the 70s, investment wisdom returned to sound principle. Solid blue-chip stocks came into vogue as investor expectation turned toward long-term benefits.
The enticement of one-time decision for large caps, large capitalization stocks, attracted conservative institutional investors who had strict fiduciary duties for the management of the savings of others. Unfortunately, well-packaged stupidity sounded like wisdom as a wave of institutional speculation occurred that focused on blue chips.
Nevertheless, these actions seemed reasonable at a time in which inflation was under control, the Vietnam War was ending, and Richard Nixon had been elected president. Investors ponder what is OPEC and who are these new upstart competitors posing a threat to American manufacturing. The Nifty 50, the largest of the S&P 500, had begun to decline, even though their share prices held steady due to the madness of crowds.
Soon, investors realized that stocks were overpriced and that it was the market, not the companies, that constituted the problem. Subsequently, fund managers began to sell their holdings in the 4 dozen or so blue chip companies.
The 1980s roared in like a lion as investors hungered for new castles in the air. New stock issues made a triumphant re-entry as the hottest game in town. However, after a stampede toward small capitalization stocks, their value plummeted 90%. Biotechnology stocks festered into a new bubble. The poster children of this biotech movement included Genentech, which watched its share price triple in the first 20 minutes of trading.
However, product asset valuation posed potential problems in the form of elusive approval by the Federal Drug Administration, unitary patent rights, and the siphoning of profits by large firms that quickly acquired the biotech startups. The large firms had no need to offset their now declining older products. As a result, the industry often considered positive sales and earnings to be drawback rather than a benefit. In the end, biotech stocks had lost 75% of their value.
What does all this mean? Under the castle in the air theory, the evaluations of securities affect their pricing. Therefore, investors should remain wary of hot new issues because they tend to underperform the market, though their stock prices increase abruptly during trading.